Welcome to our presentation on news sentiment analysis. We are abnormal distribution. The problem we're attempting to tackle is the prediction of a company's stock returns based on text documents that are related to the company. The data sources that we used in our modeling are Tingo and FinHub for news articles, key developments documents from Capital IQ, stock returns from Quandl, and company 10K's annual reports from the SEC website. These are the main modeling approaches that we started with. Loughran McDonald is a traditional dictionary-based approach in which words are marked based on their positive or negative meaning specific to a financial context. Documents are classified based on the frequencies of such words. Next, we have the pre-trained BERT sentiment model. And finally, FinBERT, which is a version of BERT specifically trained on financial texts.
So here's our idea. Stocks with positive returns are usually paired with positive news on the same day. What if we use this as a proxy of sentiment? It's easy to label every news this way. We label a text 1 if it had a positive return and a -1 if it had a negative return. To measure neutral sentiment, we assign a 0 to all news that don't have any words in a sentiment dictionary. We will fine-tune the last layer of FinBERT with this target. Financial data is very noisy. When we look at the accuracy on all models predicting today's return, we find accuracies of around 51 to 52%. It's hard to make a judgment based on this information. So our idea is this. On a given day, buy stocks with positive sentiment, sell stocks with negative sentiment, and see how they perform the next day. On this chart, we see the performance of the strategy predicting next day's return with today's news on the test set. All the models have a positive return. We see that FinBERT and our fine-tuned model have similar returns, so the FinBERT baseline is less volatile. We should measure it as a better strategy than ours. On this chart, we see the returns if we traded on this strategy as if we knew the news beforehand. And we see strong performance, which means that there is causality between news and stock returns. FinBERT performs the best in this measure, while our fine-tuned model lags. A more standardized measure is the Sharpe ratio, which is just the mean of a strategy's return divided by its standard deviation. It's a way to compare performance across stocks and strategies with different volatilities, and it's a common measure in the industry. We see that FinBERT is the best model on the test set, while our fine-tuned model performs the second best. All models have positive performance. We can see that the Sharpe ratio decays as you try to predict further into the future. So still there is some persistent effect after a few days. Also, if you try to predict yesterday's return with today's news, you get strong performance. We might have old news, or the news might have already been priced into stock prices before the news was released.
So we know that the predictions from FinBERT is better than BERT. To better understand these models, we use some visualizations to see what's happening behind the scene. Here we have an example of a negative news saying that the oil prices fell. With BERT, it cannot find the relevant keywords to predict the negative sentiment. While with FinBERT, it put a lot of attention to the keyword fell to predict the negative sentiment. Here we have another example of a news article summary, but it's positive because CPU and GPU shares went up. We can see that with BERT, although it's predicting the correct positive sentiment, it doesn't put attention to any of the relevant keywords. On the other hand, with FinBERT, it places a lot of attention to the keyword double and finally predict the sentiment to be positive for this news. Here is another example of a positive news article summary that mentioned companies signing a large deal. Again, we can see that with BERT, although it's predicting the correct positive sentiment, it doesn't put attention to the relevant keywords. While with FinBERT, it put a lot of attention to the keywords sign a large deal to predict a positive sentiment for this news.
Now let's discuss the challenges we faced in this project. Firstly, financial data is very noisy. There are multitude of repeated news across the data sets, and more than half the news lack a signal. A wrong timestamp means fake performance due to look-ahead bias. We also face long training and evaluation times with BERT. Finally, noisy targets can lead to model unlearning while training. However, our work is not done yet. Our final model is still work in progress. We have seen that FinBERT does a good job of capturing the market sentiment. We are building a model which takes advantage of FinBERT while aggregating signal from multiple sources. Our final model comprises of 3 stages. In the first stage, we extract pooled hidden states from the FinBERT for all our text datasets. In second stage, we generate an aggregated hidden state, as any given stock may have more than one news on any given day. Finally, we combine the hidden states from 3 datasets in a feature space to predict returns. That's it from us. Thank you very much for joining us.